Did you know that Australia has one of the most complicated tax systems in the entire world? I mean, they call Australia the lucky country, but considering the amount of tax that we pay here, doesn't seem very lucky. It actually feels quite unlucky most of the time. As an accountant, that makes my life harder, and as a taxpayer, that means that you need to understand what exactly you're up against. Unless you've got a good accountant who can help you save some tax. Legally, of course. So I'm going to break down how Australia's tax system works in different structures. So we're talking about individuals, sole traders, partnerships, trusts, and companies, and how taxes work for each of these different types of structures, because you need to know and you don't know what you don't know. Before we get into that, allow me to welcome you to the Wise Accountant YouTube channel. This is my new YouTube channel and this is also my very first video, so let's just see how we go with this. If you've been following me on TikTok or Instagram previously, you may have noticed my background is a little bit different, and that's because we redecorated over the Christmas holidays. So it's a new background, new channel, new video, it's new everything. And so if you want to receive more tax wisdom through my YouTube channel, please go subscribe and also give this video a like. All right, let's get into it. So let's start off with individuals. An individual pays tax at their personal marginal tax rate. Now, Australia's tax system is a progressive tax system. What that means is that the more income that you earn, the more tax that you pay. Is that fair or not? That's another question and maybe a video for another day. But if you're earning up to $18,200, you're basically earning underneath the tax-free threshold, which means that you do not pay any tax up to that $18,200 limit. Now, anything above that amount, all the way up to $190,000 and above, you can be paying anywhere between 0 to 47% in tax, which seems like a crazy amount of tax to pay. If you're a high income earner earning above $190,000, then you're basically paying half of that income to the ATO. Again, how do we feel about that? Maybe a video for another day. If you are a high income earner earning above that $190,000 threshold, there's not too much that you can do to minimize that tax if you are a salaried employee. And that's because the income that you're earning is simply the income that you're earning. You can't hide away from it. The ATO already knows the income that you have earned throughout the course of the year before you even lodge your tax return. And that's because your employer would be prepaying the tax on your wages to the ATO as part of the PAYG withholding system that we have here in Australia, which basically means that by the time it comes to you preparing your own tax return, you've already paid the tax that you need to on that salary that you have earned throughout the course of the financial year. Unless you've got other investments that can offset that salary income and bring it down, possibly through things like negative gearing, which is a very common strategy that people like to use these days, then there's, again, not much that you can do, unfortunately. Moving on to sole traders. If you are someone who is running a business as a sole trader, which basically means that you have an ABN in your personal name, you pay tax on the income that you're making in that sole trader business as part of your personal tax return. So the income from your salary plus the income from your sole trader business collectively gives you your overall taxable income for the year, which you then report in your one personal tax return and then pay tax on all of that income collectively. A lot of people think that there's a separate tax return that you need to lodge when you are a sole trader. That is incorrect. You lodge one tax return, as I said earlier, but you may also need to lodge a GST return or business activity statements, and that all depends on whether or not your sole trader business and ABN is registered for GST. If you are earning above the $75,000 threshold, which is the GST turnover threshold, then you need to register for GST. You don't have a choice about it. But if you are earning below $75,000, then you can choose to voluntarily register for GST if you want to. But that means that you need to charge GST to your customers, and also you'll be able to claim back any GST on any business expenses that you're incurring as well. One very important thing to be aware of when you're operating a sole trader business is that you are legally liable for everything, because there is no distinction between yourself and the business. So just keep that in mind if you're going to start a sole trader business, especially if you're going to start in a very high risk type of industry. The next structure we're going to talk about is partnerships. A partnership can be between individuals, companies, trusts, or a combination of these different structures. But a partnership exists when two or more partners decide to start a business together. To keep things simple, let's just use the example of two individual partners going into a business together. These two individual partners can be equal partners in the partnership, which basically means that they both have a 50% entitlement to the profits and losses of the partnership. It doesn't have to be a 50-50 split. It can be a different amount depending on what each partner is bringing to the table. The main thing to understand with partnerships is that a partnership is not a separate legal entity, which basically means that the partnership does not pay tax itself. Instead, it is required to distribute the partnership profits or losses to the individual partners. So using our example before where I said we've got two individual partners going into a partnership business together, they will each receive a 50% distribution, and then that distribution has to be recorded in their personal tax returns, and then they will pay tax on that income along with all the other sources of income that they've received personally throughout the course of the year. For example, salary income or rental income, dividend income, interest income, you name it. Even though a partnership doesn't pay tax, it is still required to prepare and lodge a tax return with the ATO, and that tax return basically summarizes all the income and expenses of the partnership and also where the partnership income was distributed to. In other words, who it was distributed to. Because then the ATO will use that to basically data match to make sure that the individual partners have reported the correct distribution in their personal tax returns. One final thing to note with partnerships is the concept of joint and several liability, which basically means that each partner to the partnership is jointly liable for all the partnership's debts and obligations. Moving on to family trusts. A family trust is, again, not a separate legal entity, and that's because a family trust is actually a relationship between the trustee, which is the person who manages and administers the trust, and the beneficiaries, which are basically people who benefit from the assets in the trust. Now, a trust does not pay tax if it distributes all of the income at the end of the financial year to its beneficiaries. The trustee has discretion as to where they want to distribute this income to. That's the whole purpose of a family trust, which is also called a discretionary trust, which is the more legal term for it. So as long as you distribute the income to the beneficiaries, who can be individuals or a company or a trust, then you do not pay tax in the trust. Instead, the beneficiaries will pay tax at their own rate. So if it's an individual receiving a distribution, they will pay tax in their personal tax return. If it's a company receiving the distribution, then they will pay tax at the corporate tax rate. And if it's another trust, then that trust will have to distribute that income somewhere else as well. So it really depends on who's receiving the distribution. But if the trust doesn't distribute the income, then they will cop a 47% tax on the income that the trust generated throughout the course of the year. So it's in your best interest to distribute the trust income out somewhere and to somebody. If you want to learn a lot more about family trusts, I actually have a whole 12 episode mini series on my TikTok account and on my Instagram as well, called the Family Trust mini series. I'll drop a link below so you can go binge watch it if you're interested to learn what family trusts are all about. But I basically talk about how you can use family trusts to save tax, why people use family trusts, and what are its advantages and disadvantages. So go give it a watch if you're interested. Last but definitely not least, let's talk about companies. Now, a company is a separate legal entity. Finally, something that is separate. And so that basically means that as the owner of the company, it gives you more legal protection because there's a corporate veil, which basically means that you as the business owner are generally protected from any debts and obligations that the company has. Now, a company pays its own tax, it also lodges its own tax return, and it is governed under the Corporations Act. So there's a different set of rules that a company needs to follow, which other structures such as sole traders, partnerships, and trusts are not subject to. So companies have a lot more red tape, there's a lot more compliance involved when you own a company. So it's a very serious thing to start a company. Don't take it lightly and make sure you remain on top of everything. And a company will pay tax at either 25% or 30%. For a company to be able to use the 25% corporate tax rate, it needs to be considered a base rate entity. Now, a base rate entity is a company that has aggregated turnover of less than $50 million, which basically means that if you own multiple businesses, all of those businesses are considered in calculating what your overall turnover is for your group. So it has to be $50 million or less. Also, you need to have no more than 80% passive income generated in your company for the financial year. So unfortunately, but also fortunately, if you are earning more than $50 million in your companies collectively, then you cannot use the 25% corporate tax rate. Okay, that I think is everything you need to know from a foundational level when it comes to Australia's income tax system. There's so many other things that we could possibly talk about. There's so many different other types of taxes like GST, CGT, land tax, payroll tax, you name it, the list goes on. We have so many different types of taxes here in Australia, but I hope this now at least provides you with a foundational understanding of how the different types of structures in Australia are taxed. And my final words of wisdom is to go and subscribe to my channel to continue to stay wise with your accounting and taxes. And also give this video a like if you enjoyed it and learned something new today. If you have any questions, feel free to add them in the comment section. So until next time, I hope that you stay wise and be blessed.